Introduction to Budgeting. Budgeting is important in both personal finances and business finances. When we budget, essentially what we're doing is we're looking at the future income and future needs we might have, cash needs, and we're estimating how much will be spent in certain areas and how we will use our funds. Just like in your own personal budget, where you try to figure out how much you'll earn in the next month or year, and how you'll account for the expenses you have coming up. Businesses do the same thing over a specific period of time. If they're planning their annual budget, they'll perhaps look at how much they earned in the last year, if they expect sales to grow, how much they plan to earn in the next year, and they will also look at if they expect any expenses to grow. At the same time, they may consider other projects or special needs that they may have over the course of their business year. Budgeting also gives us the opportunity to look at things that have not gone well in the past and to take corrective action. Perhaps in your personal budget you found you've been spending too much on pop or soda each week. This is the opportunity as you forecast your future income and expenses to decide what changes you will make to reach your financial goals. The last thing that budgets allow us to do is to evaluate where we are in terms of reaching our financial goals and our purposes. For a firm, this specifically relates to increasing shareholder value, or the value of the firm to the owners. Budgets allow us to do this while at the same time making a good plan for what will happen in the future. Steps to create a cash budget. There are 3 easy steps to create a cash budget. First, determine the cash that will be coming in. We call these the cash receipts during the period. Next, we need to determine the amount of cash that will be going out, or the expenses. We call this estimating the cash disbursements, and last, we calculate our net cash. We create the budget by having a beginning cash balance, and then adding to it the net cash flow. The net cash flow is the difference between the cash coming in during the period and the cash going out. Once we have taken the beginning cash, added to the net cash flow, we end up with an ending cash balance at the end of the period. Items included in budget construction. So the budget, we start out with the net cash during that period. As a reminder, that's the cash receipts coming in less the cash disbursements. Once we have this value, we can add it to the beginning cash we had on hand to find out what available cash we have. We then need to compare this with the minimum amount of cash that we need to keep on hand. This minimum value will help us to know whether we have enough cash for that period or whether we are lacking. If we have enough, we could possibly use some of this extra cash to repay loans or other financial obligations. If we don't have enough, we then need to borrow or obtain some kind of financing to cover that period. Once we have done this, we end up with an ending cash balance in our cash budget. Tracking, monitoring, and revising a budget. Although we might put a lot of effort into our budgeting process, most likely it will vary from what happens in the future. That is why it is important to track, monitor, and revise our budgets as needed. When we're tracking expenditures and income and expenses, it helps us know what is actually happening versus what we expected. When we monitor, we're able to look at our budget and determine, is it meeting the financial needs that we have? And is it also meeting the requirements we set for different areas of the firm? It's wise to then decide how we should revise our budget. Sometimes budgets need to be revised within a period, within the same year that you have the budget, or sometimes we revise as we move forward into the future. Ultimately, you should remember that a budget is just a tool, and a good use of a budget requires good inputs. So to make your budget most effective, make sure that you're putting in the best variables based on your past experience and your good research. Introduction to Budgeting. Budgeting is used to forecast future events, and it focuses on a specific time period in the short term of a few months up to a year. 3 major uses of budgeting are to predict future financing needs, to provide a basis or corrective action, and to provide information for performance evaluation. 6 key principles of budgeting personal finance are 1. Know yourself. 2. Understand the key areas of savings, income, and expenses. 3. Develop savings, income, and expense strategies. 4. Keep records. 5. Use a method that meets your needs and objectives. And 6. Eliminate consumer debt and minimize long-term debt. Steps to create a cash budget. Cash budgeting in a business involves determining cash inflows, estimating cash outflows, and creating a budget plan. While the basic steps for budgeting in personal and business finance are the same, personal budgeting involves understanding financial goals, tracking cash flows, developing a plan, trying out the plan, and then making necessary adjustments. Items included in budget construction. Cash receipts include cash sales and the collected portion of accounts receivable for businesses, and include salary or wages for individuals. Cash disbursements may be for suppliers of materials, interest, taxes, and so on for businesses. For individuals, cash disbursements come from day-to-day expenditures, such as groceries, gas, and insurance. For both businesses and individuals, understanding cash receipts and disbursements help you know when you need to take out loans and make loan payments. Tracking, monitoring, and revising a budget. Tracking is the process of recording cash flows. Methods of tracking a budget include the envelope method, spreadsheets, and software. Monitoring does not just mean checking to make sure that you are not overspending, but also analyzing data and looking for any alarming patterns. Revisions come after a careful analysis of a budget and should be implemented gradually to make sure that the changes are working. Summary cash budgeting is used for short-term financial forecasting, and it is useful for keeping track of cash flows and negotiating with lenders such as banks and credit unions. Budgeting is especially useful for understanding future financing needs, planning corrective actions, and doing performance evaluations. The basic steps of cash budgeting are 1. Determine cash inflows, 2. Estimate cash outflows, and 3. Create a budget plan. Tracking, monitoring, and revising the budget are all necessary to make informed changes to your budget and reach your financial goals. When evaluating a company's performance, what can variances on a company's cash budget indicate? Variances show that certain managers or divisions are not meeting targets. Cash budgets provide a basis for performance evaluation, and significant variance from predicted income, saving, and expense predictions indicates that management has not accurately assessed company operations. How far into the future do cash budgets usually forecast? Between 1 month and 1 year cash budgets are not useful if they forecast less than 1 month, and it is not necessary for cash budgets to extend beyond 1 year in the future. What are 3 principles of budgeting that are important to know before beginning the budgeting process? Keep records, develop savings, income, and expense strategies, and use a method that meets your needs and objectives. All 3 of these principles are included in the 6 principles of budgeting as discussed in the course. The other 3 principles are know yourself, understand the key areas of savings, income, and expenses, and eliminate consumer debt and minimize long-term debt. What are the 3 main uses of cash budgets? Cash budgets are used to forecast future financial need, aid in performance evaluation, and show when corrective action is needed. A good cash budget is used in these ways to help a firm operate more effectively and efficiently. What is the correct order of the 3 steps necessary to create a cash budget? Determine cash receipts, estimate cash disbursements, create the cash budget. Doing these 3 things in this order can help you understand your business, understand the timing of cash flows, and keep track of borrowing requirements. Why is put $50 in a savings account each month for Christmas gifts a better budgeting goal than save money for Christmas gifts? Because it is specific and measurable. Effective financial goals provide a specific and concrete target to focus on. Why would a monthly mortgage payment be considered a fixed expense? Because the payment is the same amount each month. The mortgage is a fixed expense, meaning that the payment amount is the same each month. Knowing which of your expenses are the same from month to month will help you budget more accurately. Which action would help you make your budget more efficient? Compare your budgeted cash flows to your actual cash flows, and then revise the budget if necessary. This would allow you to keep your budget updated and effective so you can make the best use of your money. Which item is an example of a cash receipt in a personal budget? A graduation gift of $100 from your grandmother. Since this is money or income coming into your cash budget, it represents a cash receipt. Which item represents an example of a cash disbursement a business might have this month? A rent check paid in cash to the warehouse the company uses. Since this expense is being paid this month and the cash is being withdrawn from the company's account, this represents an example of a cash disbursement. What 3 things should be included in a cash budget for a business? Cash receipts, cash disbursements, and borrowing. All 3 of these things affect cash flows in a business and should be included in a cash budget. Which items are considered cash disbursements for a business? Raw materials, rent, administrative expenses, interest, and selling expenses. These are common products or services that a firm pays cash for during a specified period in order to generate sales. Why are sales not strictly considered to be the same thing as cash receipts? Sales include both cash sales and credit sales. Sales made on credit are not considered a cash receipt until the time period in which they are collected. What is the main reason why it is important to track and record cash flows? Tracking your cash flows allows you to recognize where and how your money is spent so you can monitor your cash flows and revise your budget as needed. This is the first step in the budgeting process, and it is necessary in order to have an accurate budget going forward. In what situation might the software method of tracking be preferable to the spreadsheet method of tracking? When a person has a hard time remembering to record their cash flows, and when they prefer to use a card to make purchases, the software method is convenient for busy people who do not want to use cash or record cash flows by hand. What is the purpose of monitoring your cash flows? Monitoring allows you to evaluate whether your actual cash flows are in line with your goals and to understand when correction or revision is needed. If a business did not monitor its budget, then tracking cash flows would be useless, and the business would not know if it was on track to reach its goals. Which processes help you identify and fix problems in your budget? Monitoring your budget allows you to identify problems, and then gradual revision and implementation of new processes allow you to fix those problems. This assures that the budget is as effective as possible at helping you reach your financial goals. Use the following information to answer questions 1 to 3. W&H Company wants to create a cash budget to better manage its cash flows. The financial manager knows that the firm's labor costs and materials costs are too high for the level of sales each month. The firm also needs to keep better track of its cash flows to assess its need for additional financing through short-term loans. W&H Incorporated's labor costs each month are an example of which item in a cash budget. Cash disbursement. This is a cash disbursement for the firm because it represents cash going out during the month to pay employees. After W&H Incorporated has developed a cash budget, what should the company do in the following months? It should monitor its actual cash flows and then revise the cash budget if needed. Monitoring and revising the cash budget will allow W&H Incorporated to identify and fix any problems that may arise. Why would creating a cash budget be useful for W&H if the firm needs a loan from the bank or another short-term lender? Cash budgets increase the lender's trust in a firm by demonstrating the firm's ability to make profits and repay loans. Cash budgets are detailed plans that show creditors that a firm will have enough cash from month to month to support its operations while staying within acceptable borrowing limits. A good cash budget allows creditors to feel secure in lending money to the firm. How do the benefits of knowing the cash position for each period differ between businesses and individuals? Knowing the cash position allows businesses to recognize when short-term loans are needed, while it allows individuals to analyze progress toward their personal financial goals. Individuals do not usually, and should not, need short-term loans. What is the difference between tracking and monitoring cash flows? Monitoring involves using your tracking record to evaluate cash flows against your target, identify patterns and changes in cash flows, and gauge when correction is needed. By accessing cash flow records and knowing the remaining balance in the budget throughout the month and year, you will be able to monitor your budget in a way that will help you reach your financial goals.